Welcome to another weekly market insight. It's a actual snowstorm here in St. Louis, Missouri. So Chris and I are going to be doing this from our homes. I'm in my basement or the bunker, and Chris is in his brand new home. He just moved back out of St. Albans. He grew up out there on the golf course. And though Chris is a phenomenal analyst, he is our ringer whenever it comes to golf. So if you want to get out with elite advisors and play golf, he almost always makes it out there because if they're playing, they want to be able to use the ball that he hit, not theirs. So Chris is, if you didn't know, he's definitely the ringer and the guy you want to play golf with. And congratulations on the new home out there. You can see the snow from here. So any technical difficulties because of that, we're going to blame on the snowstorm. Any other week, it's Jess's fault. So it won't be Jess's fault this time. It'll be the snowstorm. The main thing is it's not going to be my fault. So Chris,
Thanks for that intro. That was good.
Let's jump into it, and this will be a little bit more conversational since we're not kind of doing the presentation. A little bit more of a podcast field. So price points. We went under the 200-day moving average on the S&P 500, and then popped right back above it. Monday and Tuesday last week, definitely deep sell-offs during the day and a rally, and then it's kind of kept going. I think we're 4 days now where the open has been pretty strong. Any thoughts about just kind of where we are on the S&P?
Yeah, as we see here, the technicals don't look that good. And we said last week, a lot of technical traders have exited the market. And I think we have some slides later on that'll show maybe some price points they'll be looking at that make a little more sense.
And then January, it's not as bad as it could have been if it would have stopped a week earlier. But one of the biggest drawdowns since all the way back to March 2020. That may or may not be a long time, depending on if you've experienced this market. But it's definitely felt like a lot of up time since March 2020, and we can see that here. It's been the biggest drawback since the COVID lockdown.
And you referenced it that the ending of January only down about 5%. Intraday was, of course, over 10.
Right, we did hit that.
So a little bit understated with just a January graph.
Yeah, I definitely think January felt more rough than what that graph shows. And what worked in January? Energy and financials worked. And if we look at this, it still has technology as relatively strong. We use a shorter time frame whenever we're measuring, so technology went negative on us, and we added some defensive positions in our moat strategy, which struggled last year and didn't get a great start so far this year, but it's been moving up here the last few days, which is good. We have energy and we have financials. We actually have some staples in there as well, and have really done a lot to try to hedge that technology position that we have. But man, we like those stocks in the portfolio long term. So if we have any more pullbacks, there's going to be some cushion there. We're calling it a hedged portfolio, so that we have things that are going to go up if we have things going down, which gets us to why is the market going down? Which
there was a lot of monetary policy. Heading in the last week, there was Tuesday and Wednesday Fed meeting. There was a lot of selling before that. What we got from the meeting was a little bit unexpected. It was not a projection meeting, so we don't have those dot plots that we usually go through. We really just have high-level commentary. And the Fed really is doing three things that affect the market right now. They have their asset purchases with treasuries and mortgage-backed securities, interest rate increases, and then balance sheet reduction. What we got was fully expected with the asset purchases. The market was expecting those to totally wind down in March, and the Fed did say, yes, that is the new info. They are no longer going to be purchasing any bonds past March.
Right. And the other overhang is just not the lack of fiscal spending. I guess the lack of the fiscal spending that they expected to spend, right? If I hear a budget cut because we're not spending the trillions of dollars on Build Back Better, and we're having cuts, though the deficit just hit $30 trillion, I think I'm going to scream. I'd say lose hair, but I've lost a lot of it already, so I don't think it's there. So we still had those two concerns: the Fed policy and fiscal policy. Quick slide.
We talked about the asset purchases. This is the rate increases which right now, looking at the March meeting through Fed fund traders, we see about a 90% chance that there's going to be one increase in rates and 10% chance that there might be two increases in rates. And before the meeting last week, where the Fed did sound a little bit hawkish, there was still about a 7% chance that there would be no increase in rates in March. And so that's kind of one of the new things coming out, is the Fed did sound a little bit more hawkish.
Yeah, so the market is saying, well, it's not a matter if, it's a matter of when they raise rates, and it's going to happen here in March according to the market. Zero probability. Now, a lot of people are very concerned about the hawkish tone that came out of that. And to me, I couldn't find a dove with like a hawk costume on. Google just failed me there. So the best I could do would be a sheep in wolf's clothing instead of a wolf in sheep clothing, because that's what I hear the Fed. Yes, they're going to come out, they're going to job on, they're going to talk really strong, but they're going to lose this game of chicken eventually. But it's good to see the rates move up. We'll talk about later why we don't think that that's an important component at the moment to be concerned about and getting out of the market. And then we have just the other part of Fed policy. It's not just the interest rates. Since 2008, they have all kinds of new tools. And one of those is quantitative easing. So we're getting back to quantitative tightening. And every time I think of QT, I just want to stop at the gas station and get those buffalo chicken meat sticks. I don't know what they're called. They're just phenomenal, though. So when I think of quantitative tightening, I think of those buffalo chicken sticks.
Right, and this was really this was one of the newer things that's come up the last couple Fed meetings, and the commentary around it was a little bit more aggressive than we expected. Powell said, yeah, it's probably going to make sense to not reinvest some of the maturing bonds coming forward this fall, which would then shrink the balance sheet, shrink the money supply.
Right, and we've seen this happen before. We talked about it in the previous calls. They'll begin that quantitative tightening, and in the moment that things aren't working anymore, they'll unwind that and often buy more bonds than they ever sold as they add to the assets. If the last couple of times is instructive. Most popular Democratic senator within the Democratic Party right now is Manchin. Everybody loves him. They all want to sit next to him. He is blamed for killing the Build Back Better bill. The one was a $1.75 trillion in debt. So we would have hit that $30 trillion mark if it wasn't for this guy. I think that he actually helped us and kind of stood the ground, because I didn't think that adding debt to the economy was good. But it certainly is getting priced into the market. The market would have liked an extra sugar high from that 1.75 of fiscal policy. So that's some of the additional overhang for the typical levers that people think of GDP, with tax spending and monetary policy, that fiscal policy. But then that gets us into the other thing that the market is trying to process: earnings. We're moving back into earnings season.
Yeah, we said last week we thought that this could help save some of the pullback, and things look good. It looks like that they probably are being pretty supportive. We only have about a little bit more than a third of companies reporting, about 77% beat, which is just slightly above historical average. But the main chunk of the index, the mega caps, really like 3 or 4 of those have reported, they look really strong. And part of that is, usually running up into earnings, the stock has run up expecting strong earnings, but they're actually met with 10% or so pullback heading into these earnings. So earnings look pretty good.
Yeah, it's definitely been something that we've seen recovery. One of the things that moved the market from kind of that bearish camp and very pessimistic to optimistic last week was the increased GDP, where we had expectations for inventory build to be a certain amount, and there was an enormous amount of inventory build as the supply chain is kind of coming back online and people are filling up that inventory. I don't know if that's a one and done. I would suspect that a lot of those businesses are going to continue to build up inventory. Interest rates are low, so it doesn't really cost you much to get that cash spent and put those inventory out, especially with inflation high, you might be getting it. But I think that also would have an effect on companies, on their expected earnings, if they are selling more inventory, because if to build inventory, you got to buy it from someone. That may be helping offset some of the expectations. So we'll be watching that inventory build just to kind of see what the market does and whether that we're at full inventory, and it's kind of like that one and done, or if they're going to continue to build that inventory. But all in all, I mean, for this late after the recovery, to see 77% beat ratio is great. We did not expect it to be this high, and it's good to see that. I think you're right. I think that's really helped the market kind of move higher or move back out of that pessimistic feel. So then we got profit margins.
It's not all good. Yeah, profit margins are likely going to be an issue going forward. The last full quarter is going to be that dark bar. So that's Q3 2021, 12.9%, which is down slightly from the high, but still elevated on a 5-year. The average is about 11%. So margins are still high, but we see that trend down. The lighter blue or gray is projections. And while projections are moving up slightly, we're likely at peak margin.
And a lot of that is because of labor expenses, right? And I'm going to quote my least favorite economist, if you can even quote him, or kind of go with the idea that Karl Marx said that the labor was against the bourgeoisie, or really the capitalists, the owners of the companies. I disagree with that, but it is also a fact that profit is price times value minus expenses. And labor is certainly a large expense for companies. And we've seen a downward trend since the 1970s in labor expenses as the boomers began to hit the workforce, and we had the movement of women joining the workforce. There's a lot of demographics. I think that's a better explanation for things, not Marx's explanation, where that labor pool expanded. And then we get into the 90s where China comes out of its Karl Marx practice and begins to be more capitalistic, and that labor pool expands. We've kind of hit that in the demographics. I don't think it's a coincidence that a lot of the big labor growth areas, economic regions, have kind of plateaued on their demographics, and China is already beginning its decline in demographics. So it wouldn't be surprising to see labor costs begin to move up. And if you can't make up through with volume, remember price times volume minus expenses. If you can't expand your volume at a faster pace than the expenses, those profit margins are going to be squeezed. Now, there is a secondary component that is helpful is well, now you have more people making more money and they'll be able to spend more. So it's not just a straightforward. This is a dynamic process, but we'll be watching this relative profit margins because higher labor expenses should put pressure, everything else being equal, on profit margins. So the question is have we hit that bottom? Where are we on technicals? And I like to look at retracements with Fibonacci. It's one of my favorite ways of kind of looking at markets, and it's just showing up what we see in complex systems, like how they move through. And Fibonacci found this all over, and you can apply it to markets as well. And what we're looking at is 3 different time periods of the S&P 500. The first, or the one on the left, is going from the March 2020 low all the way up to the recent high in the S&P 500. And if we were to look at just a normal retracement there, we would be looking at a price around 3,800, 3,900 on the S&P. That's a full bear market. There's still a long way to go if we were going to test that. I don't think we're going to test it. I think we're looking, or the market is looking at it more from the September-October volatility from last year. So that means that a retracement would be somewhere around 4,200 on the S&P 500. And we've talked about the amount of cash that's on the sidelines and eager to find a place and a price point to get in. I wouldn't be surprised if we've never touched that 4,200 as that cash goes in to take advantage of those pullbacks. But I would see that as a more likely place where the market is trying to understand where it can enter here. Now, if this is just a relief rally and we break through that 3,800, I think on the previous slide, that left slide, would be the bottom of a bear market if we got to that position. And then the last one is just looking from the recent high. What would we expect from the previous low kind of those price points on when to say, you know what, we're probably all clear. The market has kind of digested this and it's wanting to either move on or maybe retest. And I would say if we can get over 4,600, we can start to think about taking some of our hedges off of our portfolios because the market is able to move on. And if we hit all-time highs and get above that, then it's probably some clear sailing there. Obviously, we always have to pay attention. You got to be diligent. There's actually a technical formation called head and shoulders, where if we hit a new high and then began to sell back again and test some of these price points, we would need to be defensive out of coming out of that head. We need to be a little bit more quick on the market. But at the moment, we don't see that data. Actually, whenever we look back in history and look at Januaries that had rough starts like this, more times than not, it's a positive and actually a double-digit return by the end of the year. There, if you're looking at the left, that's the Nasdaq, or kind of closer to the Q position that we tend to hold in the portfolios. Then you have the S&P 500, the Dow Jones, and the Russell 2000. And for the most part, a rough year a rough start to the year doesn't mean a rough year. There are some reds. Most of those are going to be 2000, 2008. So you can't just say, oh, rough January is a good time to buy the market. You have to process things and understand. I remember passing the Wells Fargo sign here in 2008. Back then, I think it was A.G. Edwards, actually, now that I think about it. But it was a long process, and the market continued to struggle, data continued to deteriorate, and you were wondering, when are we going to get through this? When are we going to start to move up? And as long as that process was, we still had the bottom to drop out. So it is a process that takes its time, and we will be paying attention to data to make sure that we're more likely going up and not moving into a bear market. I think the other thing people
I was just going to say that I think it shows the general uptrend in the market, right?
Yeah.
If you start selling these pullbacks without getting back in, since those big up days usually follow those big down days, and you start trying to cash time, it just doesn't work.
I completely agree. And on top of that, most of those green numbers are well into the double digits. So we're not talking about a 5% or a 6% return. You're 15, 35, 30% return for the year. And if you think about it, if you're selling in January, let's take that 2009 on the S&P, you're down 8.5, and then you're up 35. Well, those you would actually add them, because the difference is about a 43% return that you would have missed out on from the selling the January low. So I think you're right on the upward trend. But the other item that we got to consider is, well, the Fed's raising rates. Shouldn't I be selling because the rates are going up? That means prices and equities are going up. And if you look back, most of the time, the market continues to move up after the first rate hike. And the reason is they're raising rates because the economy is strong. There's a lot of things coming out of a slow market, and I think that is somewhat reflective of today, that it's more likely that the market is going to move up. It's the last rate hike that you want to sell, not the first rate hike. Now, is this the first and the last? Way too early to tell if this is the first and the last. And they're never going to tell us when the last one is until you're looking in the rearview mirror. So that's hard to tell. But it typically is, as the Fed begins to raise rates, the market tends to climb that wall of worry, and we can see 12 months out from the first rate hike, still double digits in a lot of those years. Only one year in this example, 1987, where the next 12 months after a rate hike was negative. Now, once again, this is only historical. Past results is not indicative of future. You can't invest in the rearview mirror. So we're going to move into the next section for our live listeners. If you're on YouTube and you're listening and you want to get the information passed, please reach out on the number and or contact us from the contact information on this page here. We're going to have that up. That way you can get additional information for our live only. You can ask to be added to our text list so that you get the link to the live version, and we'll be able to access this. And if you haven't already, go ahead and hit that subscribe button. And if you're enjoying this conversation, hit the like button. Or if you want to congratulate Chris on his new home, it's out near St. Albans. Hit that like button, and always feel free to share the link with your friends.